Good evening, everyone. Tonight we'll be looking at performance management, and we'll continue from our last week topic, which is the management of receivables and payables. Last week we've looked at the cost and the benefit of giving credit. So, okay, what is the cost of giving credit? So, when you give credit, the company will face bad debt. There's a possibility of bad debt. That means customers or debtors might not pay their account. There will be an administrative expenses. So because of giving debts, the company will have to install some department or incur some costs in order for them to collect the debt from their um, receivables or from their debtors. They call it receive from their what? From their debtors. We are seeing another thing that is the cost of giving debt is that there will be a finance cost, because for you giving debt, that means you use money to purchase the goods and you sell on credit. And how will you now restock your what? Your market? That means you have to go and buy or purchase new goods. Now, because of you sell on credit, it means that you will face some finance cost. That means some interest. I mean, when you borrow money from what? From the bank, in order which equivalent to the the debt or the credit sales you make to your customers. So those are the costs of giving credit. The benefit is that the benefit of giving credit is that the possibility of higher sales return or sales volumes, because your sales volume might increase, because when customers purchase on credit, they are a tendency that they will buy more, and it will increase our gross profit, and at the end increase our annual profits. And another thing we talked about last week, we talked about the management of receivables, how we manage receivables, how we collect our debt from receivables, and what are those severe areas, other things you will take in order for you to collect your receive. All these have been treated last week. So let's try and refresh our memories or our last week class. So let's try to refresh them so that we can be able to tackle and treat this class adequately, so we can understand them our tonight class. Today we'll be starting from the debt factors and invoice discounting. Debt factors and invoice discounting. I want to say debt factor. Say there is possibility that the company myself is debtor to some particular companies. These people, they manage debt very well. So they are financial institutions that purchase trade receivables from companies uh, in a discounted manner. They purchase it in a discounted manner. That means they will not pay the face value of your receivables, so that they can make profit. So they are called debt factories. While invoice discounting, these are institutions that helps in sending your invoices. That means the company we have to outsource the sales function to these people, so they help you in the invoicing your customer and collecting your debt from your customers. Now let's from the note let's talk about the debt factors and the service they provide. So the companies might use a factoring organization to assist with the management of receivables. So if you want to, most companies, or let me say some companies, because debt factoring is not common in Nigeria. Not common in Nigeria. So though some companies have been using this approach in treating um, their debtors, in managing their receivables. So I would say companies might use a factoring organizations to assist with the management of receivables and also to help with the financing of receivables. So when you have too much receivables, receivable is not an asset. When you have too much receivables you have high receivables, then how will you not have money to run the business, to purchase new goods? So debt factors are also way of financing. They are also part of short term fund to an organization. Debt factors are specialized organizations, though they are mostly financial institutions. They specialize in one, assisting client firms to administer their trade receivables ledger. So they helps to administer your trade receivable ledger. So they helps you to manage your trade receivable ledgers. So what are those items that come into your trade receivables? Your credit sales. So they helps you in invoicing your customers. They helps you in the management of your receivables ledger, providing short-term finance to client firms secured by the trade receivables. So they can give you loans, short-term loans. So if you going to the bank to collect overdraft or short-term loans, or you can these debt factors institutions, they give short-term fund, and it's always secured on your on trade receivables. In some cases, provide insurance against bad debts. Yes, like you have two type of factoring service. You have with recourse factoring service and non-recourse factoring service. So this particular factoring service, they provide insurance. They provide what insurance to the company. The service of debt factors can be particularly useful for a small to medium companies. Which are those companies that need the service of a debt factor? So if you ask an exam, state areas or situation whereby a company uses a debt factoring. So one, has a large number of credit customers. So a company that has a large number of credit customers, a high receivables, so they need a debt factoring. Does not have efficient debt collection procedures, and therefore has a fairly high level of bad debt. So when you have high credit customers and you have high bad debt, always irrecoverable bad debt, and you don't have sufficient debt collection procedures, so such company need a, the service of a debt factor. Does not have sufficient finance for its working capital, because the company does not have finance in running the business, that is in running the operating aspect of the business. So the company actually need a debt factoring. It's a company whereby they are short of short-term funds to pay salaries, to purchase goods. So such companies, they need the service of a debt factors. A debt factors offers three main service to a to client business, to client one of the services as one, the administration of the client's trade receivables. So they help to administer your receivables. Credit insurance, they also provide an insurance premium or your insurance package to the organization. Debt finance, they also provide short-term finance to the organization. Trade receivables administration, a factor will take over the administration of trade receivables on behalf of a client. On behalf of a client, it sends out invoice on behalf of the client. Each invoice shows that the factor has issued the invoice, and the invoice asks for payment to be made to a bank account under the control of the factors. The factor collects the payment and chase customers who are late with payment. The factor is also responsible for the client is trade receivable ledger, recording details of invoices and payment received in the ledger on behalf of the client. The factors makes a charge for this service, particularly an agreed percentage of the value of invoice sent out. So they also when we talk about how do they administer trade receivables, so they helps you to invoice your credit sales to your customers. They help you to record it in your books. They always remind our debtors on their accounts, and they ensure that those that their accounts are due, they ensure they collect the payment as at when due. So when we talk about the credit insurance, if the factor is giving the tax of trade receivables administration, it may also agreed for an additional fee to provide insurance against bad debt for the client. So they provide insurance against bad debt. That means when there is bad debt, the factor will now come to the aid of the company, and they will take in the bad debt and give the company um the bad debt, the fund of the bad debt, or the amount lost due to bad debt. This is known as without recurring without recurring factoring or non-recourse factoring. So non-recourse factoring, if a customer or if a customer of a client fails to pay an invoice that was issued by the factor, therefore we accept the bad debt loss itself, and the factor will pay the client the full amount of the unpaid invoice. So when it comes to non-recourse factoring, when the company is into a non-recourse factoring with the debt factors, so that means the the factor the factor will take over the bad debt. But a factor will only provide without a recourse factoring for invoices that are provided in advance by the factor. This is to prevent the client from giving credits to high risk customers and exposing the factor to the risk of bad debt. Now, before a factor will take up a non-recourse factoring, then is the factor itself that will provide the credit sales to a particular client, because before they will provide such a sales to such client, they will have to ascertain the financial viability of that particular client. However, factors also provide with recourse factoring. With this type of arrangement, if a customer of a client fails to pay an invoice, the factor will not pay anything to the client, and the client must suffer the bad debt loss. So let's look at the debt finance. The debt finance. The debt finance. The factor will provide advance up up to 80% of the face value of the client's trade receivables, and for all receivables that are provided by the factors. Now, when you want to provide the debt finance is that they will give you up to 80% of the value of your receivables as a loan. Then they will collect your receivables in total. That means you are selling your receivables to them, and or you are using your receivables as a collateral for the loan short-term fund to be collected from the debt factor. The finance is provided at an agreed rate of interest and is payable when the customer's invoices are eventually paid. In effect, this means that when the customer pays the factor, we remit the remaining 20% of the money to the client, less the interest. So the cost of factoring service. So what are those costs company will incur when bringing in a debt factoring institutions to manage their receivables? The cost of factoring service might therefore consist of one, a service fee for the administration and the collection of trade receivables. they will pay a professional fee, like a service fee, for them to run your trade receivable. A commission charge based on the total amount of trade receivables for a non-recourse factoring service. So when they want to when they want to now give you a credit insurance, that means, which is a non-recourse factoring, then you have to pay additional commission for such additional service that will be rendered to the company. Interest charges for finance advance against the trade receivables. Yes, if you collect any interest, any fund, so whereby the company is short of short-term fund, they can use the service of a debt factor. That means they as to collect loan from debt factors and use their receivables as a collateral. Now that service also come with an additional interest charge, So which we will look at it in our subsequent illustrations. What are the benefit and disadvantage of using a factor? The benefits of using the factors are as follows. What are those benefits? One, there should be savings in internal administrative costs because the factor administers the trade receivables ledger. Now, when you use a debt factor, there will be a savings in what? In there will be a savings in internal administration costs. That means the cost that you incurred without factoring, you not incur it again when you use a debt factoring. With a non-recourse factoring, there is a reduction in the cost of bad debt. Now, when you use a non-recourse factoring, it means that there will be reduction in bad debt. At least bad debt will go down to its barest limit. Go down to the barest limit. So, using a non-recourse factoring, the company might eliminate bad debts. A factor is a source of finance for trade receivables, so they also provide finance to the organization. So what are the disadvantages of using debt factoring? We said one, that there will be an interest charge. So yes, there will be an interest charge when using a debt factor because you pay additional interest for using the debt factor. Effect on customer goodwill. Now, when you use a debt factor, it's a signal, it's a sign to your customers that the company is not liquid again. That means the company liquidity is under threat. That is why they are using a debt factoring. So, and that is a bad sign to the. So we said the service of a debt factoring is a bad signal to our customers. It shows that because the company is no more liquid any longer, and is a threat to the company's continuous relationship with the company and its customers. So it will reduce. It will affect the reputation of the company and its goodwill. The client reputation may be affected by the need to use a factor. So it also affects the reputation of the company. So they will not trust the company any longer. The customers might believe that using a factor is a sign of financial weakness. So customers believe that okay, when company use this factor, it means that they have financial crisis. So evaluation of a factor service. To assess the cost of using the service of a factor, you need to compare the total cost of the alternative policies. Now, before you can say, okay, you want to use the factor, you need to compare the cost of other alternatives. What is the cost will be incurred under this particular policy? Okay, when we don't use debt factor, what are the costs we incurred? Okay, when we use debt factor, what are the costs we incurred? So when you look at it, the cost that is minimal, that is minimal, that is the best policy the company should adopt. An indication above, the cost you probably we probably need to consider are one, the cost of receivables ledger administration. So what are the costs of receivables ledger administration? The cost of bad debt. The cost of bad debt. What's the cost of receivables ledger administration? We're talking about the interest cost. or the administrative cost, rather, the administrative cost of receivables ledger administration. Then the bad debt and the finance, which is the interest cost on the trade receivables. So let's look at this illustration. Say Blue company has an annual credit sales of 1 million naira. Of 1 million naira. Credit customers take 45 days to pay. So mostly they take 5 days to pay. Bad debt are 2% of sales. The company finance its trade receivables with a bank overdraft on which interest is payable on an annual rate of 15%. That means when the companies sells on credit, so their receivables they finance it using a bank overdraft, so which is the cost of giving credit. A factors has offered to take over the administration of the receivables ledger and collection for a fee of 2.5% of the credit sales. Now, this will be a non-recourse factoring service. It has also agreed to reduce the payment period to 30 days. It has agreed to reduce the payment to 30 days. I mean, using a debt factor, the receivable period will now be 30 days, no longer 45 days. It will provide a finance for 80% of the trade receivables at an interest cost of 8% per annum. So Blue company estimate that by using the factor, it will save administrative costs of of 8 naira per annum. That means it will not incur such administrative costs when using a debt factor. You are required. What will be the effects on annual profit if Blue company decide to use the factor service? So what will be the effect? So we want to look at the effect. So this is the suggested solution. Now, calculation of the effect of debt factoring service on annual profit. Now, to do this kind of illustration, we must look at what are the costs that the company will incur using debt factors, and what are the costs the company will incur without debt factor. The difference is the effects on our profit. Now, the first thing that we look at is the bad debt. I would now we are told that the bad debts the bad debts the bad debt is 2% of 1 million. So that means when there is no debt factoring service, the company will incur bad debt of 20,000 naira. So we are told here in our question. So we are told that bad debt are 20%. And remember that when we are talking about a non-recourse factoring, there is possibility of elimination of bad debt. So in non-recourse factoring, under the factoring cost, there will be no bad debt. That means the company will not have any bad debt. So there is no the bad debt. So bad debt is being saved. It's being saved. Another thing that we want to talk about is the interest cost. The interest cost. Now, how will the interest cost be calculated? Remember that we said the interest cost is a finance charge on the trade receivables. Now, what are the trade receivables? Now, when we are talking about without factoring, when there is no factoring, how will trade receivable be calculated? We are told that there will be 1 million credit sales, and you take them 45 days. So our trade receivables is 45 days over 365 days times 1 million, which is 123,288 naira. So but when there is factoring, we are told that the factor will reduce it to 30 days. So our receivable that we are expecting under factoring, when we use factoring, is 82,192 naira. Now, the cost, which is the finance charge on the receivables, is the 15% of the receivables, which is 18,493. So when there is without factoring, our finance charge or interest cost will be 18,493 naira. But when there is factoring, when we use factoring, and we are told that the factor will provide 80% of our receivables at what cost? At 8 naira per annum. That means the total receivable we are expecting, 80% will be financed using the debt factor fund, while the remaining will be financed using the bank overdraft. So when talking about the using when we talk about using a debt factor, it will be the summation of the finance under a factor service. So with debt factor service, 80% will be financed, which is 80% of the 82,192 times 8% plus 20% times 82,192 times 15%. So this is the the interest costs using the debt factor. So that will be the difference. If you look at it, that when you're using the debt factor, the finance charge is lower. Then we save 10,767 naira, which is the difference between the both the finance charge under factor service and under non-factor service. So another cost will be the annual savings on in administrative cost. Now we are told that there will be an annual savings of 80,000 per annum when the factor is being used. That means when we under without the cost service, there will be 80,000 because you incurred the such is 80,000. But when you are using the factor service, there will be no administrative cost, internal administrative cost any longer. So there will be no administrative cost. And we are told that this factor comes with a fee of 22.5% of the total credit sales. So the commission is 25,000. So under without factoring cost, there is need of factoring charges because there is no need for factor service. But under factor cost, there will be 25,000 as a cost that will be incurred under factor cost. So by the time you look at it, the effect is that the total cost will be incurred when we are not using a factor service is 46,493, and why the cost will be incurred when we are using debt factor is 32,725. Then the difference is the effect. The difference is the effect, which is 13,768 naira. So which is that the cost under factor service is lower. That means there will be an increase in profit with 13,768 naira if the factor service is being used. So invoicing discounting. So invoicing discounting is similar to the provision of finance by factor. A difference is that whereas a factor provides finance against the security of all approved invoices of the client. An invoice discounter might provide finance against only a small number of selected invoices. Also, invoice discounter, it will provide finance just for selected invoice. That when they give you when they give you a finance or fund, they will assess all your trade receivables and select parts that they feel that they can provide a fund on. So that's the only where only the parts that they will give you or give the company or finance or fund. Another difference between a debt factor and the invoice discounter is that the invoice discounter will only provide finance service, and and invoice discounter will not administer the trade receivables ledger or provide protection against the risk of bad debt. And if invoice discounter is just they provide the finance just for your trade receivables. They will not administer your trade receivables to collect it or not to collect it. It's none of their business. They will not provide any credit, any credit insurance on your receivables. No guarantee on your bad debt. What they do is just to send invoice to your customers. Now, settlement discount. Settlement discount is a prompt discount, taking advantage of prompt discount. Now, you see some companies they will put in their invoice under it in a note that that will be 10% discount if invoice is paid within a particular period, which is shorter than the normal invoice date. That means the normal period for customers to repay their debt can be 30 days. They will now say, okay, if customer can pay within 20 days, so within 20 days, there will be a particular settlement discount. Then how a company calculate that? Giving a discount, the company must always assess the possibility of giving discount. You should just say you want to give discount to your customers to pay prompt for prompt payment. You should look at the financial effects of the settlement discount on the profit of that organization before you give credit or discount to your customer. So evaluating a settlement discount. The benefit of settlement discount is that it reduces average trade receivables, and this reduces the annual interest cost of investing in trade receivables. On the other hand, the discount taken by customers reduce annual profits. Evaluating a proposal to offer settlement discounts to customers therefore involves comparing the improvement in cash flow and reduction in the interest cost with the cost of the discount allowed. So the implied interest cost of certain discounts, the interest cost, how we calculate that 10%. If you want to give 10%, you want to give 20% or 5% discount for prompt payment. Okay, how we calculate that percentage? So one way of evaluating a settlement discount is to calculate the implied interest cost of offering settlement discounts. So you can compare it with the bank overdraft interest rates. So compare it. Why are you giving the discount? Why not use that period go and collect loan and continue your operation rather than giving discount? So you have to compare both. A formula for calculating the implied cost of offering a settlement discount is as follows. So the formula is 1 plus D over 100 minus D. So D is the number of the discount days, the discount size you want to give, then raised to power 365 days over T minus 1. So where D is the size of the discount. So what size of discount are you giving? Is it 10%? Is it 5%? So Then T is the difference in days between the normal credit terms and the maximum credit period for taking advantage of the settlement discount. So you have to compare this rate with the bank overdraft. Now let's look at illustration. Now we help us further. Illustration. So illustration 4. So Liverpool Limited borrows on overdrafts at an annual interest rate of 15%. So this is the overdraft when the company used to borrow money. Customers are normally required to pay within 45 days. Liverpool offers a 1.5% discount if payment is made within 10 days. So you are told that, okay, for example, you are the customer now and they offer you discounts of 15%. You have to ascertain if you should collect that discount, that you should pay within that days, or you should withhold the money and go and invest it. Because if you invest it in a short-term bond or a short-term instrument, the interest that we yield, you should only compare it. This is a financial aspect we should all also understand as a student. Also, for you to take discount, they'll tell you that, okay, lecture fee is this, you pay within so date, they'll give you so discount. You have to compare a certain discount if it's favorable or not. What is the effective annual cost of offering the settlement discount, and is the discount policy financially justified?
Come and come in.
Now, what is the solution is that using our formula, our D, which is the set of discount, which is 1.5%, and our T, which is the difference between the 45 days and the 10 days. So the width, the boundary, is 35 days. So it's 15%. We are giving customer 15%. We are giving customer 15%, and we can borrow money from the bank 15%. I give customer 17% rather. We can borrow money from the bank in 15%. That means we are giving 2% higher than what we can borrow from the bank. That means the settlement discount is not viable. It's not viable. Therefore, offering the settlement discount is not worthwhile. It is cheaper to borrow on overdrafts at 15%. So, settlement discount is not it does not worth it. So let's look at other illustration. Calculating the total annual cost. Now the cost. Now instead of calculating the rates, we want to know the cost, the effect of settlement discounts. An alternative method of calculating the cost of settlement discounts compared with the policy of not offering discounts should be to compare the total annual cost with each policy. So with discount, with a discount, and without discount. And let's look at this illustration. Illustration 5. Chelsea PLC borrows on overdraft at an annual interest rate of 15%. It has an annual credit sales of 5 million naira, and all customers buy on credit. Told that customers pay using 45 days. Now, Chelsea PLC offers 1.5% discount if payment is made within 10 days. If payment is made within 10 days, and we are told that is 60% of customers take the discount. Now, out of everybody, 60% will take the discount, while 40% would not take the discount. What is the annual cost of the discount policy? Also, not the annual cost of the discount policy. Now, let's look at our solution. The first thing we want to do is to calculate our average trade receivables without the discount, without a discount policy. Now our normal receivable without a discount policy will be 45 days over 365 days times 5 million, which is 616,438. Now by the time you multiply it with the overdraft, so we have, then you multiply with the overdraft, we have 92,468. Now, what is the interest cost? The interest charge. By using the discount policy. Policy. Now the customers that will not take the policy, because when we use the discount policy, now what we do the discount policy now? Okay, it's 60% will take the policy. Now 40% will not take the policy. That means if 60% take the policy, 60% will be financed. Using the new credit limit. Why the 40% will be financed using the old average receivables. Now, if there is a discount policy, the customer that will not take the discount will be the 45%. They will pay. Those are 40% will not pay within that in 10 days. They pay within 45 days. Then our receivables will be, for that period, will be what those that will pay within 45 days, which is a 246,578. Now those that are not paid within that 60 days, within that 10 days, will be 60%. So by the time you add them together, it give you the 100%. So you have to add them together to know the total receipt that you will be expecting. But when they say we are using the policy, 60% will take, 40% will not take, then the total receivables during that period will be the summation of those that will take and those that will not take the discount. So we multiply it with our interest cost, which is 15%. So the difference is 49,315. So we have a savings of 43,151. And we are told that the settlement discounts, there will be a cost. So there will be a cost. The settlement discount cost of 5 million times 60% times 1.5%. So these people that will take the people that will take the discount, that will be the cost of giving that discount. The cost of giving the discount is 60% of those that take the discount. 60% that take the discount times 5 million. So by the time we take that, we have an extra cost of 1,849 naira. So the total discount will be expected to reduce annual profit by this. So I say it's not viable because the cost is 1,800. So it will reduce profit. So the discount, the policy of giving discount is not worthwhile. It's not worthwhile. Now, the management of working capital for foreign trade. So how we manage our working capital for foreign trade. So when a business entity sells to customers in other countries and the customers is in a country with a different currency, there are extra problems for finance, for working capital management, and risk for the business. The extra risks are the longer time period, because it's a foreign customer. There will be longer time period for him to pay back. There will be greater risk of bad debt. If foreign customer does not pay, it will be more difficult and expensive to take action to collect the bad debt, because when it does not pay, it will be more difficult. How are you to chase the debt in a foreign land? It now give us a greater risk of bad debt, and most especially there will be a foreign currency risk. Now the foreign currency risk, that okay, what is the risk that you will face if a company invoices in a foreign currency, there will be a foreign exchange risk. This is the risk that the value of the foreign currency might deteriorate when the time of issuing the invoices to customer and the time of the payment. Now, when you say the foreign currency risk, so that when you invoice for customer in a foreign land, the value you will record in your books might reduce at the time when it will pay, because your quote is using the foreign currency, so it might reduce. So that is a further risk that the company will face for selling in a foreign land. Now, obtaining a quicker payment. Now you obtain a quicker payment. Now you can obtain a quicker payment. In many cases, a company that sells to foreign customers must accept that it will have to wait longer for payment. A large investment in foreign trade receivables could therefore be unavoidable, and the interest cost has to be accepted. However, in some cases, it might be possible to arrange quicker payments. One method of both reducing the bad debt risk and obtaining quicker payments is to arrange an export sales using a letter of credit. So you can obtain a quicker payment using a letter of credit. There is always secure your what your your foreign receivables, maybe with any insurance company or with a bank. So a letter of credit is an agreement with the exporter undertaking to provide the foreign buyer with specific document that provide evidence that the goods have been shipped. The required so the required documents normally include the suitable shipping and insurance document and an invoice. So when you give such a letter of credit, so it will reduce your credit risk, and the customer will pay earlier than Nigerian do, because there is an insurance that cover the goods that are been shipped. So when there is loss, the customer can also fall back to um the insurance, being the insurance company, to repay them back their lost. Now, protection against credit risk. So also, now let's talk about payment of trade receivables. So we can read this up out of our time. Let's talk about our payment, management of trade receivables. Do we manage our trade payables, or is it almost similar to do we manage our trade receivables? So trade receivables as a source of finance. Trade credit is an excellent source of for financing short-term working capital needs. The supplier has provided goods or services that have not yet been paid for, and which may or may not already been have been used. The trade the credit trade the trade credit allows the buyer to hold or make use of the goods obtained from without yet having to pay for them. It therefore proposed the need to find the cash to make payment for goods and services purchased. So this is how we can this is just like we looking at the what should we pay as when due or not. Settlement of discounts from suppliers. So we can use our formula for settlement of discounts from our supplier. Should we take up the discount, or shouldn't take up the discount? So we can use that formula to also treat this question. So treat this question. So you're saying so Inter Milan PLC is offered a 2% settlement discount if it pays invoice from from supplier X in 10 days rather than after normal 30 days credit period. It can borrow on its overdraft at 50% per annum. Require what is the value of settlement discount? So this is the way we set. So the formula is given to us by look at the value of a settlement discount is 44%. It's 44%. 44%. So the settlement discount is more higher than the bank overdraft. Inter Milan should take the discount and pay invoice on 10 days. The discount that are given to us is 45%, which is higher than the bank overdraft. So as a customer, we should take the discount. So they take the discount down. So with this, we've come to the end of this topic: management of payables and the trade receivables. So next week we'll look at a new topic, and the topic is very, very, very important, very, very important. So good night and God bless you for your time.